let's get cracking here. 3rd of August, Bank of England Day. We've got monetary policy news flow coming from the Bank of England just around the corner, and we've got a Carney press conference. It's coming around about lunchtime. We've got services PMI data to look out for. We've already had China's numbers. We'll talk about those shortly. We're going to get Europe delivering on services PMIs, plus then the US focus on the ISM non-manufacturing data later on. So plenty of data to come. This is a chart now, just here, big one on my screen. This is the Dow Jones Index. I'm actually looking at a weekly time period here. So, looking at across, I don't know what that is, about a year and a half, or back to the start of sort of 2016 here. And, obviously, this has been a phenomenal rise, and lots of talk this morning about 22,000, although now we've pulled back slightly, but yesterday's high 22,025. So the march continues. You can see that actually just from a classic long point of view here, that key break of the February high, so this is going back now to the end of May, start of June. That's been a good platform to work off, and we've been pretty relentless on the upside. If you look at the daily chart, it's 4, 5, what is it? 1, 2, 3, 4, 5, 6, 7. Yesterday was 7 days in a row of new all-time highs being set as we, finally take out that 22,000 handle, obviously for the first time in history. So US equities, seem to be continuing to plod higher. A lot of yesterday's move was thanks to Apple, up 4% after strong earnings or strong guidance. But here's an interesting chart. I'm going to flick screenshot. Look at this. This is actually looking at the S&P 500 index daily change going back over 18 months, back to the start of 2016. And so even though equities seem to just be persistently driving higher, what this chart is showing is that on the upside, this is the S&P though, not the Dow, but on the upside, we've only had 2 rallies, daily rallies of more than 1% in this entire period. Only twice. And the last time was right the way back in April. So only twice in the last 18 months. Sorry, this is not 18 months. Apologies. This is just looking at 2017. Sorry, that the positioning of 2017 on the x-axis confused me there. Sorry, this is looking back over 7 months that have been completed. So sorry, only twice this year have we seen the S&P rally over by more than 1%. And as you can see in the last month or so, while stocks have been just drifting higher, the size of these rallies are very small. Obviously, we've had some sell-offs, and indeed we've only had 2 sell-offs that have been more than 1% as well in this period, which should be noted. So actually, this is just generally telling the story that the volatility levels have collapsed once again, and this is a rally, but it's a sustained rally, but one that's coming at a very slow speed. Although when I transition back to that Dow chart, it actually looks pretty steep. But these moves to the upside are not coming in, single bursts of dramatic upside. It's all very steady and slow and consistent. So equities continue to push higher. Apple certainly a big part of that story yesterday. For the S&P, even though the S&P finished up on the day, just actually 299 of the 500 companies saw their share prices drop yesterday. So Apple certainly coming in and skewing the index overall result. A lot of volatility on, well, yesterday I was going to, let's talk currencies and then we'll have a look at oil yesterday before we look at what's happened overnight, and we talk about things like Trump, and we'll talk about services PMIs. And we'll talk about the Bank of England. But let's have a look at an update on the currency space. Obviously, a lot of talk on currencies of late, mostly due to the fact the dollar has weakened so dramatically. Of course, we've been talking about this all week, so I certainly won't go over the reasons for this again. But just to say that yesterday, a bit like the Dow Jones, really, this is just punching to the upside on a consistent basis. And this 30-month high, 119 getting taken out briefly yesterday, so we got a new high for 2017 here. Yesterday's top coming in at 119.40 basically. So continued dollar weakness, continued euro strength. If we have a look at cable on a daily chart quickly, let's move a couple of these lines. Then again, cable also joining in with another push higher, although certainly you've got a couple of dojis here on the cable daily chart, which is suggesting that the upside momentum here for cable isn't quite what, as perhaps sustainable as you're seeing on the euro dollar side. But still, we did make another new high yesterday. That's another new 10-month high. We'll talk about cable a little bit later as we just preview and get ready for the Bank of England event that's coming at lunchtime. But you've still got this dollar weakness in the mix. Let's have a look at oil. A lot of volatility off crude yesterday. Difficult one to trade. I mean, here we are now. Overnight, we just drifted back away and back down to the pivot where we've had decent support so far, trading at 49.35, which is around about the sort of top side of the range we had following the Department of Energy numbers delivered yesterday. And let me just remind myself of the precise numbers that we got. So on the headline for, just looking on my news feed now, the crude number came in with a drawdown that was lower than expected. So less of a drawdown than expected, certainly much less than we saw the week before. And so, that's bullish. And in the end, we got a bullish move. But of course, to start with, we sold off and tested the low. And that's because the second half of that kind of data set was showing that crude oil production had again gone back up. That was the important thing about last week's data. We saw crude production drop in the US. Big surprise. Well, this time round, it's gone back up by an equivalent amount that it dropped by last week. So that was the kind of news flow that was negative for price. Just on the underlying stuff. Gasoline, bigger drawdown than expected. That was bullish. Sorry, I'm thinking about oil there. That crude number was slightly bearish, but anyway. A big number on gasoline that was bullish. Actually, quite a big number on refinery utilization at plus 1.1%. Anyway, always very tricky to trade the inventory data for sure. A lot of violence, a lot of chaos, and in the end we punched higher. Didn't get to $50 though. And if we have a look on a daily chart, we had that big step back lower on the 1st of August, back on Tuesday, and then we're just in this kind of consolidation zone, you would say. Still at the top, of course, of what has been a 2-month-long rally, where we've come off the floor down at $42 back on the 21st of June. We've rallied a clean $9 here, which is 20%. We were talking about oil being in a bear market. Technically, back mid-June, a bear market is one where the price is trading 20% or more below previous highs. Well, we're not far off a bull market now, which is where you're trading 20% or more above previous lows. So these big dramatic swings in crude continue as we wrestle with this supply side dilemma, or at least OPEC do. And are Saudi going to drive a deeper production cuts or not? And how are the US shale industry dealing with this consistent price point well below $50, etc. So oil certainly still, certainly an interesting market to keep your eyes on. Let's have a look at some of this data let's catch up a bit on Trump first, because that's, certainly helping with some of this dollar weakness, of course. A couple of stories on Trump to catch up on. So here's one. This is a headline at the FT this morning. Trump grudgingly signs flawed Russian sanctions bill. This is quite an interesting move from Congress, and certainly a big part of this fear that Trump has been colluding with Russia. Essentially what this bill, it's quite a clever move by Congress, I would say. This bill passed through Congress absolutely immediately almost a 100% support from it. And what it essentially does is it basically chops Trump's power. It really takes his power away from being able to make moves on foreign policy without Congress's say. This bill gives Congress 30 days to veto any kind of policy change driven by the White House about foreign policy. Normally, Trump's complaining about this. He signed it anyway, but he's complaining because it is quite a bit of a pretty dramatic step away from how things normally function in the US, which is where the White House calls the shots on foreign policy and on national security. The White House can make moves and doesn't need Congress to vote through any new bills. They can make a move as they see fit. But obviously the big fear is that Trump's colluding with Russia, and Congress are paranoid about this, and so they've slipped through this bill. And it's Trump can't not sign this, because if he didn't sign it, well, wouldn't that make him look more guilty? So he's almost been forced to sign this, and this kind of then curbs his ability to have autonomy on decisions surrounding not only Russia actually, but also Iran and North Korea. So it's quite an interesting one. It maybe reduces the Trump uncertainty risk, the Trump stupidity risk. Is he going to do something stupid with regards to North Korea, for example? Is he just going to wake up one morning and decide, let's get on with it? So it does reduce his ability to do that, which you could say reduces that uncertainty risk. But it does increase sanctions on Russia at the same time, and that's the important point to make. Not only is this chopping his autonomy on these kind of policies, it's also increasing sanctions on Russia. Russia are not happy about this, and a lot of noise out of Russia this morning saying that this is going to dramatically ruin, or not ruin it, I was going to say ruin. I'm talking about the relationship between the US and Russia. It's not like not like they're besties, but the hope from Russia's side was Trump would come in and this would see a game changer and a dramatic turn and a change in direction with regards to US and Russia relations. And Russia this morning is saying, Trump, you are impotent. I can't believe you've signed a bill that you don't agree with. This shows you are an impotent leader. This is a significant change in the medium to long-term outlook for the relationship between the US and Russia. So they're not happy. So this is one story. The other story then, to kind of counter this, Trump's come out and backed a proposal. This is a Republican proposal to cut US immigration in half. This is where they're looking to move their immigration policy more towards a sort of Canadian / Australian points-based system. And so this isn't new law. This is now Trump backing a proposal from the Republican side. Obviously now the wheels will get into motion, and the Republicans will draft a proper bill on this, and then they'll try and obviously get it voted through, first the House and then the Senate, and let's see. But given what happened with Obamacare, there's a huge amount of skepticism about, can Congress function? Can Trump get any policy through it? And we've got bigger fish to fry. Well, not that this isn't big, but I mean more imminent factors. And number one is the debt ceiling. So they've got to renegotiate or they've got to negotiate and vote through an increase to the US debt ceiling. And given the problems they've had with Obamacare, this might be difficult. So this could well cause a lot of problems as we get into kind of September, October. And then obviously the bigger thing, and certainly when you look back at that chart of the Dow Jones and the S&P 500, one of the reasons these markets are so high, one of the reasons is that, they're waiting for this big tax cut. They're waiting for Trump to deliver corporation tax cuts. And of course, the progress Trump's made since he's been in office on delivering new laws, new policies has been spectacularly bad. Summed up perfectly by that Obamacare fail last week. So we shall see. So obviously Trump always in the news, always something to be keeping your eye on. That goes without saying. Right, let's have a catch up on what's been going on overnight. So we've had some Chinese data, and this is the beginning of what is the services PMI day. So on Tuesday, we had the manufacturing PMI data. And here today, we're going to have the services sector. And this is the Chinese chart. And we had a print come in at 51.5. This was slightly lower than the expected 51.9. And as you can see, it's been a bit volatile in quarter two here. With that step higher we had in May, but immediate pullback, and now this is the fourth month, 4 out of the last 5 months where we've had a number around about 51.5, and as you can see, this is quite significantly lower than we saw in quarter 4 last year and quarter 1 this year. So we're a little bit disappointing, this, you would say. What we've got today, if we just have a look at the economic calendar, then we're about to get a huge raft of European numbers, and in fact we've just had the Italian services PMI announced. Just going to refresh my headline feed. So that number's come in better than expected at 56.3. We had expected 54.1. 56.3 for Italy. That's actually pretty punchy. Let me just get the chart out on that, just to get a sense for how that measures up to numbers we've seen more recently. 56.3, yeah, as I thought, that's actually a new high for the last 12 months. We've just edged out the April reading, which was 56.2. If you look at a 5-year, wow, that's 10 years. Wow, right, that's the 10-year high. Let's look at how far can we go back here. We can only go back, actually that's not 10 years, is it? This data on this chart only goes back to 2011. So it's definitely at least a 6-year high. Here for Italian services PMIs, and it continues what's been a pretty strong run for Europe, you know, generally speaking, for data. If I showed you, let me see here, I'm going to bring up a chart which is looking at European PMIs more broadly. Let me make that a bit smaller. So this is looking at, let me size this so you can actually see it. So this is looking at the European, or the Euro area PMI, and just looking at 2017. Look at the dark blue line, very steep climb in Euro area PMI readings, making it new highs since the start of 2011. You know, this has been a real underpinning of what's been a very good year for Europe from an economic kind of momentum point of view. This is why we're getting things like this euro appreciate in value quite dramatically. People are talking about how this is going to be hugely damaging in the end for European exporters. There's plenty of articles this morning actually in the press talking about how actually people are exaggerating this effect. It's not going to be a disaster. You know, the euro trading at 119 in the grand scheme of things isn't an onerous burden that's going to be a game changer towards economic growth. But one thing that we were worried about, this blue line had dipped a touch, but obviously numbers like we just had from Italy, well, that suggests perhaps actually this slight dip we've had in the last couple of months isn't a more meaningful reversal of the trend here. So this is a nice solid reading from Italy. If we go back to the calendar, we're going to get, you would probably say, more important numbers coming. So we've got France in 1 minute's time, so in 15 seconds. Let's see, I'm going to turn up my mic here. Oh, sorry, turn up my speaker to get the headline coming. So it's 55.9 is expected. That's what we had previously announced. These are the final readings. So we've had preliminary numbers on these a couple of weeks ago. So 55.9. What will be the most important one is Germany coming in at 8:55. So let me just see on this French one. A bit of a delay on my headline feed. Anyway, the most important one is from Germany that's coming in about 4 minutes. Here's the chart for the German PMI data set looking back over the last few months. So we've had a bit of a dip off what was a very strong run of form. March, April, May, you know, all up at 55.5. Then we've stepped lower, and we're expecting this step lower to be continued. So we're expecting something in line with what we was announced a couple of weeks back, okay, which was a new 6-month low. All right, so that's the German data that's coming. Then back to the calendar, we're going to get the European data as a whole at 9 o'clock. But don't forget, we'll have had all the kind of the large European economies reporting individually already. Just to complete the set, the Spanish one came in actually slightly weaker than expected at 57.6. So the other big thing on this calendar then is at 12, Bank of England. So we've got the MPC vote. And this is interesting, given what happened last month. So last month, the 8 voters on the Monetary Policy Committee, 5 of them voted to not change rates, to keep rates at a record ever low, 0.25%. 3 of them voted to hike. That was a big surprise. We weren't expecting 3. We were expecting 2. So Forbes was the outlier. She came in and voted to hike, surprisingly. This was a hawkish outcome. We ended up getting some sterling strength off the back of it. Here's Forbes. What you need to know about today, Forbes is no longer part of the Monetary Policy Committee. She went out with all guns blazing. She stepped down and retired from the committee as planned, on schedule. But before she left, she delivered a surprisingly hawkish vote. But she's not voting now. Instead, we've got Tenreiro. I'm not sure if I'm pronouncing that right. Tenreiro is now stepped in her place, and we're expecting her to not rock the boat at the first meeting, and we're expecting her to toe the line and vote for no hike. So what we're expecting is 6-2 today. One thing to be, and we'll talk much more about this nearer the time, but one thing to note is the inflation pressures that we had back at the last meeting at the beginning of July have dissipated somewhat, which just takes the pressure off the Bank of England, and therefore we're expecting obviously no change. We're expecting a step back to 6-2 on the vote count. What we will be getting though is Mark Carney having a press conference at 12:30. They will be updating their inflation forecasts. They'll be updating their GDP forecasts. We'll get the vote count all at 12 o'clock then, and we'll get the minutes from the meeting as well. So a series of bullet points from, just a summary of what's been discussed. Then at 12:30, Mark Carney will have a press conference. Okay, so we've got kind of 2 stages to this Bank of England event this afternoon. Just completing the data calendar. The other big number of the day is this one down here. ISM non-manufacturing. It's due at 3 o'clock. We're expecting 57, which is a slight drop from June's reading at 57.4. Okay. I did have a chart actually on sterling volatility just to finish before we concentrate on the German data. This is looking at volatility levels, comparing the euro and the pound. That's volatility versus the US dollar. And just how we've had such a strong downtrend. Look at the white line. Sterling volatility trending lower throughout the whole of 2017. Just in recent weeks, you've had the euro finally cross up above that. So we've got a cross here. You're getting more volatility on the euro now against the dollar than you are on the pound. Right, I'm going to get off the mic and I'm going to end the briefing now because I want to get the traders' minds focused in on this German data. German PMI, non-manufacturing or services sector PMI, and we're expecting a reading of 53.5. Okay, that's it from me for now, guys.